Federal home loan banks are poised for a meltdown, but the GSEs are not, and the Fed holds off on raising rates until the economy improves. Ahead on Thursday's News Wrap. In its annual report to Congress, the FHFA published the results of its Dodd-Frank stress test that assesses what would be the impact of immediate financial shocks and 9 quarters of adverse economic conditions on capital levels among institutions with at least $10 billion in assets. So what's the verdict? Federal home loan banks came through sparkling, but the GSEs not so much. According to the FHFA, all 11 of the federal home loan banks maintain compliance with regulatory capital and leverage capital requirements over the 9 quarters of the stress test, with the banks of San Francisco and Seattle projecting assets well above regulatory minimum. Fannie Mae and Freddie Mac each projected draws from the U.S. Treasury Department to the tune of billions. In the severely adverse scenario, Fannie Mae projected additional between $34.2 billion and $94.9 billion. The Federal Open Market Committee once again stood still on raising the federal funds rate this month due to disappointing economic indicators, leaving the looming question of when the Fed will make its move. The Fed said, quote, "In determining the timing and size of future adjustments to the target range for the federal funds rate, the committee will assess realized and expected economic conditions relative to its objectives of maximum employment and 2% inflation," close quote. You can check out these stories and all the latest happenings in the industry right here on our site. Thanks for joining us, and we'll see you again Friday at the MReport.com, your source for latest news and strategies in the evolving work.